this business, there's going to be no certainty, right? You've got all this changing information, all these new inputs, but you have to learn to be comfortable with uncertainty.
We're just looking at price. We're just looking at trend. Trend is the only thing that pays. For guys that are addicted to the market, addicted to trading, they're addicted to, quote, action. It's a license to build your wealth if you know what you're doing.
Your ultimate success or failure will depend on your ability to ignore the worries of the world long enough to allow your investments to succeed.
It's okay to get out, but you have to know when to get back in and when are you forced and to get back in? When are you forced? You're forced when the trend changes.
All right, everybody, welcome back to the Trayline Conference. It's my pleasure to introduce the next speakers at the event. They are repeat presenters. We always love hearing what they have to say, and they always share very valuable insights. So I'd like to introduce Roy and Wes Mattox, both at IFS Invest. Roy is the Chief Market Strategist and Portfolio Manager, and Wes is the Chief Technical Strategist. Thank you guys so much for being part of this today. They'll be discussing the market trend, how to determine it, how to look at those turns, and going through some very valuable case studies today. So Roy and Wes, a pleasure to have you guys back. And yeah, looking forward to this.
Thank you, Richard.
Great. Thank you, Richard. Hello, and hello, everyone on the stream. Thanks so much, Richard and the Traderline team, for having us back for, I think, our third year on this conference. So, we're happy to be a part of this partnership, and we love what Traderline does, and the growth on the platform has been really impressive over these couple of years. So Roy and I hope to add some value to that, and we can hopefully help some people learn something, or just reiterate some ideas too for some experienced traders today. And this is just a disclaimer, right? We're not going to give financial advice here. We're offering some information for educational purposes, so please discuss your investments with your investment advisor. And so just a little background about us. Roy and I, we're co-portfolio managers at Integrated Financial Strategies. It's an registered investment advisor based in Charlotte, but we have clients all over the world. Roy has nearly 40 years of experience in this business, and his career began as an analyst at a major bank in Houston. After graduate school in 1985, he was employed by A.G. Edwards and later moved to Charlotte as senior vice president at Payne Weber. He holds a degree from LSU, an MBA from LSU, and he's been leading the Charlotte Investors Business Daily meetup group for several years now. I'm Wesley Mattox. I graduated from Chapel Hill in 2015 with majors in economics and math, and started in equity research in 2015. I covered financial technology stocks initially, and later moved on to support top-ranked analysts, one at UBS and another at Wolfe Research, covering transportation sectors there. And I joined Roy in early 2022 at Integrated Financial Strategies. And like I mentioned a second ago, Roy has been leading this Investors Business Daily group for Charlotte for several years now, and me as well now for a few. And so I'm sure most of on this call are familiar with the book How to Make Money in Stocks by William O'Neill, and his often cited CAN-SLIM acronym for leading stock criteria. Much of what Roy and I do at Integrated Financial Strategies is grounded in William O'Neill's work, where we are trying to hold a concentrated portfolio of leading stocks for our clients. And so we host this meetup group, which is open to the general public. It's on the second Tuesday of every month. We share our thoughts on the market and go over candidates for who we think are the current and next leading stocks of the market. So if you have any interest, please visit this link on the slide, and don't miss our next meeting. So on this slide, we want to show a broad list of what we consider in technical analysis. We break technical analysis into 4 different categories: of price, breadth, sentiment, and ratio analysis. So if you don't have a technical analysis background and want to know more It's a good comprehensive list of things to look at. And we monitor all of these things in our routine on a daily basis. So by far, the most important part of technical analysis is price. And so we're going to focus primarily on the trend today. And so trend is the primary consideration for investing based on technical analysis, and paramount for success to stay on the correct side of the trend. So there are a few other indicators listed here that you can look into on your own time that measure things like momentum and if a stock is, quote, overbought or oversold. But for this presentation, we will really be looking at the short-term trend and how you can take this very simple signal of the 10-day and 21-day moving average crossovers to amplify trading results. And so, why is there such an emphasis on trend? And what about fundamental analysis? Doesn't that matter? I mean, of course it does, but we find that there's so much noise, information that you are bombarded with regularly through TV, internet, Twitter, friends and family, and there are all these news stories and concerns that people have all the time. So it's nearly impossible to sift through everything, and there's always worries in the world, whether it's the U.S. debt downgrade, an upcoming election, recession fears, the latest PCE report. We know price is going to incorporate all of this information, and it's the best source of truth when you have to sift through all the noise that's out there. So in this business, there's going to be no certainty, right? You've got all this changing information, all these new inputs, but you have to learn to be comfortable with uncertainty. And we find that technical analysis keeps you objective and gives you an ability to act with incomplete information. It can never be complete because there's new information coming out every hour of every day. But we do believe the price and trend give us the most complete picture of the economy that we could ask for. So now we're going to get into the sort of meat of this presentation, and Roy's going to take over and look at some charts. We're going to review some key trend changes in past bear markets and starts of new bull markets. So we're going to look at 11 snapshots of the past and then look at where we are today. Our focus will be on what we consider short-term trend changes, with the 10-day moving average crossing the 21-day moving average. And so, as you can see, William O'Neill from his book, The Importance of Market Direction, here he states, if you're wrong about the direction of the general market, and that direction is down, 3 out of 4 stocks will plummet along with the market averages, and you will lose money big time. And so that's why we're so focused on this, because he's obviously right about this. It's really hard to find, winning stocks and have a winning trade when you're fighting the trend. So with that, I'm going to hand it over to Roy, and he will start with 1987.
Thank you, Wes. Okay, so Richard and I, we'd had this conversation, and Wes chipped in. We wanted to really achieve something simple but elegant in its simplicity in the presentation today. And that is, we wanted to help you and educate you in terms of what is a trend, how do you determine a trend, how is a trend developed, how can you utilize the trend in terms of incorporating that to assist you in making your investment decisions. We firmly believe that this simple, elegant approach can be the difference between you flying first class or flying coach, or really achieving your retirement objectives, achieving your wealth objectives, and so forth, if you employ these techniques properly. So we wanted to lay it out for you over the last 40 years and show you, well, what's the trend? What was the short-term trend in these major bear markets in the past? How would we illustrate that? How would you identify that? How would you react to that? And how would you utilize that in your investment decision? So quite simply, the short-term trend for us is determined when moving average crossovers take place. When the short-term 10-day exponential moving average is above the 21-day exponential moving average, we believe that indicates the market is in a short-term uptrend. When the 21-day is below the 50-day simple, we believe that's when the market is either in a short-term or intermediate, or excuse me, an intermediate term uptrend or downtrend. And when the market is below the 10-week moving average, and really we're looking at the we're looking at the Nasdaq and we're looking at the S&P primarily for this to occur. We believe the market is in a long-term uptrend or downtrend when you have two closes below that 30-week moving average. We're going to just concentrate on the short-term trend today on these 10 various illustrious examples. So we think that you will benefit from that. So in our chart, the green line is the 10-day exponential moving average. The magenta line is the 21-day exponential moving average, and the 50-day is the simple moving average. So you see that in 1987, when we hear everything that occurred in 1987, and we had the crash, the biggest crash that the market has experienced since the 1930s. And in 1987, what happened was economic growth slowed for three quarters. We were coming off the stagflation in the 70s. The market had already declined 10% before the crash, and investors were jittery. So in this particular case, you see where the market peaked in August. And then we had this double top in October, and you had adequate warning to move out of the market. At all these tops that we're going to look at today, you had individual stock participation that waned. You had this breadth decline. You had momentum that was declining, and you had this distribution days that were mounting up. So that was the backdrop in terms of the macro conditions in 1987. So we see that the 10-day crossed the 21-day. You can see where the downtrend began in 1987, which was a week before the crash. Now, what's interesting, and Wes made a nice table on this so that we'll take a look at this from a summary perspective, but in every particular case, we took the time when the crossover took place and we measured the difference into the market low, and that is what you would have achieved if you got it, if you actually exited the market at those particular crucial points and got in at the market bottom. Now, note you will find that these short-term downtrends from a market top, they don't occur at the top. They don't occur exactly at the top. Typically, it happens within 5%, and that's when the momentum is waned. And by the time you get the crossover, you have exited your positions. But if you haven't, if this is a novel approach to you, this is basically illustrating that if you did not exit your positions because the leading stocks were topping, you had less and less participation at the top, you had distribution days that were mounting at the top, this would have forced you to go to cash and get out. So that's the point, that the primary point that we're making on all these charts is there's the downtrend, and notice the market bottomed, and notice the market did not follow through and go into an uptrend until several months off the bottom. But believe me, those 2 months off the bottom was so devastating in terms of the declines that people had experienced, and the news headline was so negative that people that had gotten kicked out of the market or that sold at the bottom, those guys probably never even got back in. So when the trend changes, you have to change your opinion, and that was the time to move back into the market. You can see in that 1987 period that we've illustrated on the chart. So next. Okay, in 1990, in this is the 1988, excuse me, 1988, 89 bear market. And in this particular time, let's see here, it was caused by a combination of factors, such as we were in an 8-month recession, and we also had the Gulf War that we were getting in front of. So you can see this is in 1988, 89, the market peaked. So this is the 1990 peak.
1990, yeah.
Okay, the 1990 peak. You can see the month, and notice this downtrend, how devastating a downtrend like this might occur. And what we're pointing out for all of the participants that are watching the show today is that in these downtrends, it is virtually impossible. There might be a 1 in 100% chance that you can make money being long when the market's in a downtrend. We think that the market direction is the most important part of the acronym, and the market direction is very, very important. It's going to be very, very difficult to find stocks breaking out to new highs when the market is in an uptrend, in a downtrend like this. You can see the market downtrend in 1990. We had a 31% drawdown. If you got out after the top, when the downtrend shifted to a downtrend, and you moved back in, you can see clearly on the chart where the uptrend resumed again. And so these simple techniques will keep you out in the market downtrends and get you back in when we start a new uptrend after a bear market. And that's when all the money is made on the long side. It's coming out of a bear market. And then as we transition from a bear market where everything is in a stage 4 decline, everything moves to stage 2, and you have a plethora of stocks that typically break out, a new leadership emerges. And those are the stocks that lead typically the next cycle that can power gains of 100 to 200% up if you're able to identify the true market leaders. So we're not going to be talking in the presentation today about identifying those true market leaders. When we do cover that in our presentation and our monthly meetings, our meetup group, but we're simply discussing trend today, which is a snapshot in time for us. You can see the follow-through day in 1991. There was a follow-through day right at the bottom that nailed the bottom. You had another follow-through day in 1991, and that was a rare 3-day follow-through day. I think we've only had one of those where we had a 3-day follow-through day. Typically your follow-through days are day 4 to day 7, or sometimes a little bit further than that. But in this case, you had a follow-through day 5 days off the bottom to signify a potential trend change, to get you ready for a potential trend change. That should, when you have those follow-through days after a bear market, particularly the first ones, that should alert you to now is the time to do your homework, to pin your ears back and get some of these new leaders. And you can see we had, again, that follow-through day in January 1991 that led to enormous gains in 1991 in stocks that I owned at that time, such as Amgen, Costco, I think US Surgical, and Microsoft. That was a huge winner as Microsoft converted over from DOS to Microsoft Windows and so forth. Next. Okay, the 1998 bear market was caused by a number of macro factors, notably the Asian financial crisis, and we had the Russian ruble crisis at that particular time as well. And incidentally, this would have, if you were looking using these simple trend signals I wasn't using them before 2000 to 2002 because I had not gone through a devastating bear market like we had in 2000 to 2002. That's where I came up with these short-term trend signals to put us on the right side of the market. So it took me it took me 12 years to come up with this, and that's only going through the 2000 to 2002 bear market that I developed this strategy. But since then, it's helped us navigate through all the bear markets with minimal declines. And it's kept it's kept our capital intact. So you can see here in 1998, the top, and then had the big break. And back in 1998, the leaders were, and this was just a huge break in the market. These were the internet stocks like Yahoo and AOL. I wish that I could go back and pull those charts up, but my software doesn't, it deletes them when they're no longer, if a company is bought out, or if a company is delisted or inactive and so forth. But I had, and I owned a tremendous amount of AOL and Yahoo that I got stopped out of on actually the second move down. You can see where we had that market bottom in September, and then we had this brief move up from September, October, followed by the retest in October. And that October retest right there, that's where the real bottom took place. And that's when AOL and Yahoo then subsequently took off for many hundreds of percent gain from there. Qualcomm was a big winner of ours as well from 1998 to 2000. So you can see that the follow-through day that occurred there on the retest in October signaled an early potential trend change, that a potential trend change might be taking place. So you had that in September. You had another one that was there in October. So basically in October, you really started counting again because you actually undercut that September low. But if you were, during this period of time, if you're out of the market and you're not investing using that follow-through day methodology, the trend you can see where we went into that uptrend when the 10-day crossed the 21-day, that satisfied our the necessary burden of proof that we're looking for, where the 10-day is crossing the 21-day, and now we are in a new, at that particular time, short-term uptrend. So long-term uptrends don't occur unless you have short-term uptrends first. You can see the short-term uptrend was definitely, of course, intact at that particular time. Okay, the next was in the 2000 top. And again, the 2000 top, Bill O'Neill, after the 2000 top, came out with a book that's entitled The Successful Investor. That is, that's a tremendous resource because it brings you back and helps you understand what happened in 2000 at the 2000 top, and how did that 2000 to 2002 bear market unwind, and how could you have avoided it? So that's the most important takeaway from what we're trying to demonstrate today. So in early 2000, you can see on the NASDAQ, we had the double top, and stocks had a tremendous move. And from 1998 to 2000, we had what was known as the internet bubble. You had dozens and dozens and dozens and dozens of stocks that went straight up, that blew off, that had no earnings. It just anything that was associated with .com went up. Companies were changing their names and adding .com, pet.com. They were adding a .com to the end of their corporate name. And any of those companies that did that, the stocks just took off. And so it was a bubble, and it was a feeding frenzy. And in fact, at this particular time, we had just had 5 years of 20% returns. And just to show you how bullish the sentiment was and how excessive it was, everyone that you conducted surveys with during that time expected another 5 years of 20% returns. And so anytime it gets that good for that period of time, you can understand that we're going through just an irrational period of time, and that's not going to last. The market is going to revert back to the mean. And the mean is, the market is averaged 8-9% for the last 80 years, on average, despite 14 to 16% pullbacks that you can be assured of that you'll get once a year. So here, the bear market lasted from 2000 to 2002, and we'll take a look from that March 2003 day, because we are utilizing these patterns and to look at currently to see, well, how does this compare to the 2003 turn and also the 2009 turn? So that's important information for you to look at. So this is the first half of the year in early 2000. You can see the downtrend. And so again, with that double top, you would have been kicked out of the leading stocks by the time the downtrend was in force. But again, you didn't, in this particular case, the NASDAQ dropped from 55,000 to 4,500 before before it triggered. And so, you're not going to, because you're trend following, it's going to be a lagging indicator. When you look at trend, you're not going to get it out exactly at the day of the high, but you can see that you got out within 5% of the high. And here you can see the market then was in this downtrend. And notice, you can see when you're in a downtrend, you can have brief 2 to 3 day rallies, but if you're trying to trade those, you must sell those. It's very, very difficult to trade, in particular your entire portfolio, for 3 or 4 reflex days, rallies in a bear market. It's psychologically defeating, and it's fatiguing, and it's exhausting as well. That's why we think it's important to just avoid these downtrends and just participate in the uptrends, as much as reasonably feasible. So you can see here the uptrend took place, months, a few months later. You avoided all the carnage that took place from that downtrend to the market bottom. And let's take a look at the next slide, Wes. And in this particular slide, this is from a lower level. And you can see in this particular case, the late 2000 bear market, the market dropped another 57%. And I am happy avoided the majority of all this downtrend. And so this is the whole key, that the market is going to repeat itself. There are going to be people's behavior in fear and greed. Supply and demand will never change. And so this is just a simple technique to keep you on the right side, of the major trend.
Yeah, and
So
Roy,
here's the
I was
two.
just gonna jump
Yeah.
in, because you see how long this particular downtrend was, and you've kind of got that fake signal at the beginning of 2001, sure, and then back to the downtrend. But if you don't have
Yes.
something that can keep you objective like this, it's just, you think about if you just stay out, how much mental capital you get to maintain. And because it's really, really hard, I know, to stay out for, this is almost like 12 straight months. So anyways, that's what I really, enjoy about this, especially when you get in these prolonged downtrends. I think it's super valuable to really, help you stay on your hands, versus, trying to guess a bottom. It's just, that's exhausting. So I like, this period of time shows you how helpful it can be during a particularly long downward move.
And just jumping in as well, I think it's very relevant. Obviously, in recent history, we've got the 2022 bear market, which is kind of similar to this. There were multiple false breaks up to the downside. But Roy, I like how you pointed out earlier the follow through day and also the 1021 EMA signal. It's the start of a mindset shift where you have to start thinking positively and looking for longs. And I think that's one of the keys that you guys are trying to share today is having an objective measure like this, like you said, Wes, make sure that you protect yourself during the worst of it, but also you're ready and ready to take action once a new trend starts taking hold. You start putting on exposure, testing the waters, and that way you're participating during the uptrends, the long-term uptrends, which awesomely are usually a lot greater in magnitude and duration than these downtrends, which you guys are sharing.
Well said, Richard. Well said. Okay, next. Okay, and you can see this is the 2002, the bottom, and you can see Wes has just blown this up to show you again the devastating decline there, and that accompanied this bear market that we had. You can see the market, the market bottom there, October of 2002, and then I believe we actually had a retest in 2003. But notice, notice where the market bottom place, and then we had the follow through day, and sometimes you'll have a follow through day, sometimes you won't. In '87, we didn't have a follow through day until after the trend change, which is quite unusual. And other periods, you have follow through days and the follow through days that don't work. I think Richard is going to probably, is Eric Kroll speaking?
Yep.
So he'll have some great information. We look forward to listening to him and his team as they talk about the follow through days and the ones that are significant, those that weren't, that didn't work, and so forth, just looking at the data and so forth. But again, when you're trying to establish market exposure, where you're trying to establish when do I dip my toe in, you have to do everything incrementally. And we certainly have learned from Mark Vinny how, in terms of incorporating his trading style into ours, in terms of how important it is to make incremental exposure. So just because a follow through day occurs doesn't mean you should go 100% invested on margin, and that would be a recipe for being chopped up, and could be a recipe for disaster if that follow through day of course doesn't work. But what's nice is that your mental capital is intact during a period like this, where everyone else is basically in the fetal position. And everyone else, they're not opening in their statements. They're listening to CNBC to see what the next pundit might say to bail him out. And people are not making their own investment decisions. They're listening to someone else. Here we're clearly laying it out for you so that you can see that this is what we're talking about here is unencumbered by market noise and market opinions. We're just looking at price. We're just looking at trend. Trend is the only thing that pays. Next slide, Wes. Okay, so in 2007, that 2007 to 2009, during that bear market, that was perpetuated by the housing bubble, the subprime mortgage debacle, and banks being overexposed and over leveraged on their balance sheet. So you can see this during the great financial crisis, the NASDAQ was in a downtrend at this particular point. You can see where we went into a downtrend. And this was followed, so this 2007 was one of my best years trading the market. I had a big winner in Google in 2007. And but it was followed by this bear market from the 2007 top to the 2009 bottom. But you can see the downtrend and how long these downtrends last. And you will just, I mean, it's always great when you're making money in the market, when the market is in an uptrend, particularly when the averages are at all-time highs. But this shows you the flip side of the coin. And what I want you to take away from this is you can see that these were months where you should have been out of the market. So for guys that are addicted to the market, addicted to trading, they're addicted to, quote, action, the market's not the place for you. This isn't a gambling casino. It's a license to build your wealth if you know what you're doing. So we're showing you this simple technique to keep you out of the bear market and keep you in the bull market. So that's what we want to illustrate to you today, so that on the next bear market, you can navigate it successfully by adopting these techniques and these tactics that we're laying out for you so that you can visually look at them yourself. Notice here, there's a 43% drawdown right there. Boy, that's enormous. And believe me, from 2007 to 2009, you had stocks that dropped 95%, because remember, growth stocks drop twice as much as the indexes, typically, in many cases. And this year's winners are next year's losers in many cases too. Just look at Zoom after the 2020 top, Teladoc after the 2020 top, DocuSign, Fastly. We could go on and on and on. Next. Okay, so in 2018, we had a trade war with China. We had a slowdown in growth, if I remember correctly, and we had the Fed raising interest rates too quickly. In that 2018, that led to that bear market. And you can see the bear market, that bear market took 20% off your capital after the top. Notice how this is pretty darn close to the top, right? You can see the double top up there, the trend change. And incidentally, occasionally the trend might change, but it can occur at the same time that you're breaking the 50-day on volume too. So many times the 50-day breaks first. It breaks hard, and then a day or two later you'll have the crossover as well. So you're going to have individual stocks that break. You're going to have the averages that go through the 50-day in many cases, and then the trend changes. So so if you're watching closely, you'll see distributions mounting, stocks aren't participating, and that will bring us on our last slide. We'll talk about what's happening today. So we'll bring you up to present on that. But you can see here in that 1988, If you're out when this trend is clearly down, then the market finally capitulated on the as it cascaded to that bottom in 2024. And we were credited with coming out with a piece on December 24th after the close saying that we thought that's the market bottom. And we were exactly right during this capitulation. That happened to be on Christmas Eve. And so that's really one of the best quote calls of my career on as the market bottomed out there on the whoosh down and so forth. Notice notice that if you don't have the tools necessary to try to gauge bottoming action, you had the trend that took place a couple of weeks later. So the market went from this downtrend to an uptrend. So you had, remember, you're not getting out at the top. You're not necessarily getting out at the bottom, but you're getting in so that you can enjoy 80% of the uptrend and miss 80% of the downtrend. Next. Boy, this was amazing. And this was amazing. Obviously, this was the COVID crash of 2020. And notice in this particular case, see, you had the break of the 50-day on volume. Notice, and this is, Wes, will you illustrate that on the chart there in February of 2020 over there? Thank you. So you can see the 50-day, the break, and there's your exit point to get out right there on the break of the 50-day. And then the trend followed a couple of days later. And this was the most brutal and the quickest bear market that we've ever experienced, over the last 4 decades, in my view, where you were down 35% in a month, in 4 to 8 weeks, and you recovered the entire move, in the next, 8 weeks. It's very, very, very rare to ever experience something like this. And this is when the news headlines, of course, at the bottom was as bearish as I've ever seen it in my career. And so we had the follow-through day, you can see after the bottom, and then the market went into an uptrend after that. And, if you're not looking at these tools and you're licking your wounds, and if you got out and it's okay to get out, but you have to know when to get back in and when are you forced and to get back in? When are you forced? You're forced when the trend changes. Now, in reality, as you study and you go back and you look during all these time frames, go back and look at who are the biggest stocks during that, during the bull markets. And you can see that many of them, you don't know in the bull market the new bull market, who they're going to be. So in many cases, it is easier to just buy the indexes like the NASDAQ or the S&P when you have, when the trend first changes. So it's okay to get market exposure if you're not following individual stocks or you don't know who those leaders are. Sometimes it doesn't happen simultaneously when the market bottoms. You don't have stocks that break out to brand new highs. They typically happen over the next 4 to 6 weeks after the lows take place. So there's an incubation period where the setups take a little time to present themselves. And, so it's interesting. Go back in 2020, for example, and look at the Tesla bottom when the market bottomed here on 2020. Look at Tesla. Look at Shopify. go back and look at some of these stocks, and you can see where they looked on the charts. They weren't at new highs at that particular time, but they were setting up to launch themselves to make a major move over the next 2 to 3 years. And then 2022, we really did what we think is a really sound, legitimate execution that we executed, pretty well in 2022, considering the NASDAQ dropped 35%, and I think the S&P dropped 30% from the high to the low. Here you can see the downtrend that took place the beginning of 2022, and I believe we went to cash right here when the market had topped after 2021, and we were forced into cash. Notice the break of the 50-day on volume there, right before the downtrend was commenced. Actually, the next day, the 10-day crossed the 21-day. So you had an early warning. The break on big volume, a big break on the downtrend there in 2022 to signify, okay, it's going to be difficult and choppy. And that's what occurred for the majority of 2022 until you finally bottomed. Okay, let's take a look today, and you can see in there, we believe that a new bull market in growth took place it began in November 1st, 2023 with that follow-through day. And so during the last few years, it's been choppy, it's been difficult, and the trend, the way that we, by observing the stocks that have participated from the November follow-through day to today, we believe that we're in a new bull market of unknown duration and of unknown magnitude. So you can see that's where we are today. And just to give you an idea, well, how would you utilize this? Well, for us, we were 100% invested during this November through this period of time, all the way through this to March, April period of this year. And then we saw this topping action that took place. So we noticed, you can see, we had some distribution that was cropping up. We had periods of time where the market opened strong and closed weak. In those cases like that, where Wesley has indicated that, and we can. So what we did, we were 100% invested, and we started selling. So we went from 100% invested to basically out. Wes, did we get 100% out then, or were we like 15 or 20% long?
So what I remember is a Thursday where things looked like we were about to get going, breakout. Friday there was this Israel news, and a reversal day, kind of expectation breaker type of day. And I think we started probably selling that Monday a lot. And we wanted to hold on to Nvidia being the leader, but we know during that period of time, when it peaked to the bottom, probably down here, April 14th or 18th or whatever that is, that was a 20% drawdown. So I think we held on to that until we saw it breaking the 50, the last kind of leading stock breaking the 50, whenever that day was. So yeah, I think by that point, on that day, it was a Friday, I believe, too, where we went fully to cash. And then, just wait. Again, we're looking for just a simple trend change. We were out for 15 days, and then we saw the trend change again. Yeah. And we're, very quickly, nearly fully invested again, early May.
Yep. So no, that is, and Richard, you can probably chime in here in terms of how, what happens when you're trying to, when you're seeing a situation like this, in your experience, when you're a potential trend change, raising cash, and then how difficult is that to employ cash again, Richard? What's your experience?
It's something that I'm still improving on, especially kind of the rapidity, not rapidity, how quickly I'm getting back exposed. That's like the tough part for me. But
Yeah.
you know, I've started developing like hard rules about you know, when that trend changes to the upside again, I have to put on TQQQ or QQQ to a certain amount. And even if I don't know exactly what the leaders are right at that moment, because some of them may develop, you know, in the next few weeks, having that exposure initially, if the trend starts working, gives me that profit cushion. That
Mhm.
then, you know, gives me confidence, you know, things are working, and then I can redeploy that capital to new leaders as they break out, or just kind of keep riding that core of TQQ. So that's actually a question I wanted to ask you guys later in the Q&A, is that transition from cash to when we're in a new uptrend. How do you guys go about it? How quickly do you guys look to um, go back to close to fully invested, or you know, how much you guys want to be invested, and what kind of things you look at in terms of you know, if you have any rules about, hey, I can't change my exposure levels more than 20% in a day or something like that. So I don't know if you guys wanted to touch on that now, or just kind of table that for the last Q&A, but I'm sure that's, you know, that's a very hard part about trading. That's catching those turns. So kind of up to you
Yes.
guys if you want to address it now, or table it for just in a little bit.
Well, what we and while you have me here and it's on the tip of my tongue, uh, now what we did was we ended up selling and taking a lot of profit and like selling. We sold half of a lot of our winners. We incrementally moved out,
Right.
and what we did was the stocks that we sold. And we sold stocks like DraftKings and Uber and other stocks. We sold them correctly, and then we bought them back as they came in, but they didn't hold. And so we found that on the pullback, we were buying on the pullback, and they didn't hold, and we got kicked out because we had probably 5 to 8% losses in them. And then we had to pivot and determine, well, who are going to be the new leaders in the uptrend. Normally, the stocks that were leading the uptrend, they're going to, in a pullback like this, it's going to be the same leadership, but you just need time for those leaders to breathe and set up for 2 and 3 week type patterns. For example, like right now, we had this market that made a new high on Friday, and you had potentially a key reversal day. You opened strong, closed weak. What does that suggest? Well, Wes is going to take a look at on the next slide about MACD and a couple of things. And we're not getting into using tools a lot, in terms of dialing down into the specifics, in terms of looking and pulling that up right now. But you can see that the momentum is somewhat waning, just a degree. But we think this is setting the stage to pause for semis. And we think that semis aren't necessarily over, but they're breathing and they're going to pause here. While other groups like software is coming back into favor and some other stocks are rotating. Again, small caps and mid caps were up on Friday, and we think a potential rotation may be taking place there. But we waited for that for the last 2 years, right, for that quote rotation to take place. But until large cap, mega cap stocks are going to lead until they don't. But it is important to watch them right now to see, well, do they have another leg up to go? Are they going to participate in this AI bonanza, or is it over? We think that there by no means is this over. We think that you're just getting started in AI and the ramifications of indoctrinating AI through our whole society.
Mhm.
And we think that's going to lead to great productivity, higher prices in the market, higher valuations, better earnings, and a better market environment for the second half of the year, fueled by also the seasonality of the presidential election year and other things.
Yep. And well, Richard, I was just going to mention something about that question. I think you said you put on the Qs, made the TQQQ. I think we do the same thing a lot of times, especially on a follow through day when everything's kind of beaten down and, because of follow through day, right, coming off of the low, there aren't a lot of stocks, of course, going to new highs. So, we find that definitely index exposure is just a good way to get that exposure. I think on this day too, where we broke above the 50-day, I think NVIDIA was probably breaking above the 50-day. I think we were looking for a number of those to kind of, not necessarily be at new highs, but the leading stocks would recover their 50 days first. So I think that was probably those were a couple of actions I bet we took that day. And then you see when the short-term trend change right there over the next 5 days, it did give you a lot of time to see things, and you can see the market was consolidating and having this sort of short handle, shallow handle. I'm sure a lot of stocks were doing the same thing, but I would say we're not going from 0 to 100% either exposure in a day. It's certainly going to be more measured. I bet 30% changes would be like the most we would do in a day. Maybe going from 0 to 30% could be reasonable for us.
Yeah, perfect. And when we're kind of in a trend like this, so this is stepping forward in the trend a little bit, and maybe also talking about the trend that started last fall. As we get further on in there, and you start to see downside reversals like we saw in March, and we start just kind of treading water sideways. How are you guys changing things with regards to aggressiveness of new positions if you're taking them, as well as balancing taking profits on maybe your weaker holdings if you start to notice the market's getting a little bit extended from the moving averages, if that's something that you guys do?
Well, we just sold. We de-risked about a week ago when we saw the momentum waning just a degree, and we sold. For example, we have a core account that's more a longer term strategy that we employ, and we have a swing trading account. And in our swing trading account, we sold 100% of NVIDIA. We had a 20% position, and that we made 50 to 60% on the last trade, the last time we put it on. So that that trade right there provided with over 10% of return to all of our accounts with one stock. So that shows you the benefit of concentration, Richard, of course, as you know. And if for our long-term accounts, I think we sold 75% of NVIDIA at that particular time, about on the peak, when the stock peaked at the day that it peaked. I think we sold it for 139, 137 the day. I think the high was 139. And that allows us to now trade around and be able to buy these positions back without having much of a drawdown, if the market rose here. Now, based on the market trend here, you can see where the market came back to the 21-day a couple of months ago. We would expect the 21-day to be in play next week. So we would think that the 21-day would be in play, that you'd come down here, shake you out a little bit, and then see what happens. Now, what's nice about these shakeouts is it's going to allow you to see who leaders are. And we think that NVIDIA is setting up again, that the stock can go much higher from now, but it's going to go through. It needs to go through, and it may be going through a brief consolidation or digestion point. So what also is useful, Richard, is to go back and study America's Greatest Winners from AOL. Those models that they put out, so that you can really see how these green line breakouts take place on stocks that have many moves before it's over a number of years. So that's what we're looking, that's what we're trying to identify right now. We think that NVIDIA, of course, might be a major winner from here. It's going to be the most valuable stock. It could be the biggest stock of all time before it's over. But if that's the peak, and stock's got to consolidate, it's got to come down to support, it's got to make new highs for that to happen. So this is it's a sort of a watch and wait period in a stock like that to see how see how they set up or not.
Mm-hmm.
Mm-hmm. Great. So if we want, I guess we can kind of proceed a little bit more through this. We've got a few more just things to touch on and get back to Q&A shortly. But Roy, did you want to go through this, kind of summarizing what we just looked at, and then I'll talk a little bit more about the today trend and some other thoughts.
Okay, this shows you the date the actual crossovers took place. So guys that are watching, go ahead and, of course, print this out, write this stuff down, so you can go back and you can incorporate this in terms of your, your analysis. But, we wanted to address it while the market is in a firm uptrend, the market's as bullish as it possibly can be, to prepare you for the next leg down whenever that occurs. And we don't think that we don't think that we're going to have a major leg down until we think that this market can rally to this time next year before you've got an ultimate peak in the averages. Next.
All right, so yeah, the next couple slides we'll talk about, this is just kind of like a checklist, basic checklist if you want to take a look and just step back and see what what are all these indexes signaling. And this is just looking at what we consider trend over different time frames. And so NASDAQ, S&P 500, checking all the boxes, right? Short term, long term, medium term uptrends. We know that the story has been similar to 2023. This first half of 2024 has been the narrowness of the market, and that kind of continues. And you can see that with the Russell, after a great November, December, has really failed to move anywhere and has had trouble breaking out, right? There's been several false breakouts, I guess, of the Russell over the 6-month period. So we're still not there on that basis for the Russell to be in I guess an uptrend, but it is turning. It is turning very recently, where the short term has improved for the Russell. And so we didn't touch a whole lot of momentum, but there's a few ways to look at momentum. And what we were seeing perhaps is finally that rotation. I think that was kind of the consensus view in January, that small caps will outperform. Has not been the case, but we're always looking for that signal. Okay, when is it going to happen? Because when that does happen, that's when the trading environment gets very easy. So we're kind of looking at the Russell as that indicator to us if we're going to enter an easier trading environment. And so of course, we have that backdrop that still is about inflation and rates and all that. And it seems like we're getting closer to real conviction that the inflation rate's coming down to 2. But I think that when there is confirmed market conviction, we're going to see this positive trend change in the Russell. Maybe we saw that within the last week. The daily MACD, the moving average convergence divergence indicator that we look at for momentum, that turned positive for the Russell, as well as the price phase. And meanwhile, the NASDAQ and S&P 500, which have been those kind of top heavy, heavy concentration indexes, those have actually seen slowing momentum. So we're looking at, the possibility, sure, a little bit of short-term weakness, a little bit further, like Roy mentioned, coming to the 21-day, sure. That seems like a possibility in some of these major indexes, but The weekly momentum on these indexes is positive. Not yet for the Russell, but it's very likely that that momentum on a weekly basis turns up for Russell if we get an actual breakout in that Russell index. So momentum, it's just a derivative of price. So it's telling you the same story as the trend and everything, but you can see right here, like the Russell maybe is giving you a day or two early signal with the momentum change here. So you can kind of incorporate this into trading and hopefully improve your edge a little bit. And then just a couple more confirming resources for the market, like direction or market health. Um, some of the things we consider: new lows, point figure, all positive. Are we within, 15% of new highs? Because that's, really a more healthy pullback, or really even less than that would be ideal. But also just wanted to point out this Minervini stim model. We use his service for, and he's got this sort of monitor of what, for the stock trading environment, and it can be red, orange, or green. And orange makes a lot of sense. We had some success in breakouts for a couple weeks, and now it's kind of a bit of a mixed bag with that. IBD, they offer this exposure kind of suggestion. So right now they're at that 80 to 100% exposure suggestion on their website. And so that changes, based on if, for instance, distribution days are racking up, or if, we're just pulling back more and, maybe breaking the 50 on the indexes. There's, I guess there's a number of things. So, these are other things you can use to kind of confirm, hey, are they seeing the same thing as us? Like, what are we missing, if anything? So some more things to consider with the market direction. And we'll end it here. So, Roy mentioned this quote earlier this week, and it spoke to us, and we thought we'd just share it to end it on. Your ultimate success or failure will depend on your ability to ignore the worries of the world long enough to allow your investments to succeed. And so, long-term success we think is absolutely achievable and probable while you're investing, because we live in the United States and we're just lucky to have this fishing hole to cast our rods into. That is the U.S. stock market. So people are, constantly doing amazing things, working on the next big thing. And we're here to emphasize trading with the trend, because there are always going to be reasons not to invest. The most fundamental thing you can do and incorporate into your trading is trading with the trend, because year after year and decade after decade, the U.S. stock market tends to move up and higher as companies are created and as those companies grow and how they change the way we live, work, and play. So with that, that kind of concludes our presentation. If we have time for more questions, happy to take them if you have a few, Richard.
Yeah.
But again, here's some links. Let's see, helpful investor resources. We really like William O'Neill's work, of course, and I know you guys at Traderline do too. And a reminder, join our meetup if you'd like. It's open to everybody, just once a month, and we share some thoughts, and would enjoy having you guys there. And if you want to reach out to us, connect with us, you have our email and Twitter handle. So please do so if you'd like to.
Yeah, perfect. Well, thank you guys both, Roy and Wes, very much for putting this together. It's such an important reminder of, both the devastation you can avoid if you have, objective measure of trend like you guys presented. And also, of course, you have to have a way to also objectively, make the mindset shift to get back in at the same time. I do have a few questions here. I think we've got time for a few here. First, could you guys kind of differentiate between an intermediate term correction within the context of a longer term uptrend and something more like what you guys were sharing with the snapshots of, more significant bear market corrections? I think that'd be a good distinction to mention.
I think intermediate corrections, Richard, would be something along of 10% or more. So, the market's going to have, many of these 3 to 5 to 8% corrections,
Hmm.
and we view that as being in a short-term correction, short-term drawdown. Intermediates are 10% or more, and then of course a bear market would be exceeding 20%. So you never know. You never know when the short term is going to turn into an intermediate term.
Right.
You never know when the intermediate term is going to turn into a long term. But you have to. But these are tools so that you can react. And again, we showed where when the trend, at that, that May time frame where when the trend changed, we were bending. We're not buying when the trend changed and it's going down. We're selling. But then, but when the trend, when we were confident that the bottom was in and the trend reversed back up, then of course we put money back to work. And how, it takes a little bit of experience to be able to dial that up and dial it back accordingly. But, we're not going to be buying, and we don't advocate buying stocks, when the market itself is in a downtrend. Nothing is going to work. So that's why it's crucial to watch these indexes. We do know that individual stock participation is everything, but you're just not going to get setups when the trend is down. So that's how we recently, reacted, and we're up, I think 35% in our swing trading accounts this year, and in the 20s in our core accounts. And that's despite having the drawdown, the pullback, and getting out and then getting back in. But that's insurance that you pay. And we think it's important to always have insurance on the largest part of someone's wealth, their investment portfolio. If you have insurance on your house, you certainly should have insurance on your stock portfolio, and that insurance is being able to sell and de-risk and reduce
Richard, I was going to say though, for this first pullback that we kind of experienced, I think for months leading up to that, let's say March, at least March, February, March, April, we were talking to our meetup group about it, and we had said, okay, we were looking at the '09 and the '03 starts of bull market. So I think that context was important. That in our opinion, we were about 5 months into this actual bull market, right?
Right.
And so, we were all looking for this, okay, 7, 8, 9% pullback. And that is exactly what we got. So I think that gave us some confidence that, okay, it's probably one of those intermediate corrections, not necessarily the start of a new bear market. But at the same time, even knowing that, that 8% pullback manifested itself in a 20% pullback in NVIDIA, and we're not going to hold that stock for a 20% pullback, especially when we have 10, 15, 20% position, in that stock. So that's the whole thing. It's all fine to hold these indexes through pullbacks like that, most likely, but we can't do it in stocks just because that volatility is 2-3 times as much.
Yeah, excellent, excellent points there. Another question that I want to ask you guys was, you mentioned multiple times today, momentum was waning to the upside, so you're kind of not necessarily like predicting that there'll be a pullback and a signal that comes, but you're expecting it maybe and preparing for it. What are some signs that you guys pick up on in terms of the price action of momentum waning that could lead to an intermediate term correction, or something more significant? Obviously you don't know at the time, but just to make sure you guys are protecting yourself, setting up that insurance, so if we do get the pullback, you guys are ready.
Well, that's a great question, and I didn't know if we were going to pull this up or not, but let me pull it up since you asked such a pointed question, Richard.
Sure.
Okay, so let me share my screen and I'll show you. I'll answer that for you, and this might be useful for the investors and traders on the call today. So let me share my screen.
Yep, it's coming
Oh,
up.
this is the program that I use called, the name of it is AIQ. I've been using this over 30 years. And do you guys see this? This reflects the NASDAQ chart right
Yep.
here on AIQ.
Yeah.
Do you see this clearly?
Yep.
We do.
Okay, so this is what got our attention, Richard. Okay, price phase is one component of the MACD. The MACD is, it's a technical indicator that it's quite common. It's very, very useful at market turning points from the tops to the bottoms of the correction. What we wanted to point out, and we pointed this out when we de-risked, Richard, and this was a week or two ago, where the price phase, you can see that it's measured by this histogram that it turned from up to down. Do you see where the stop made a lower high on this price phase on this day? You can
Yep.
clearly see that right there on that day. And this is what Wes and I were using to say, hey, okay, be ready for a momentum change right here. And a momentum change isn't a trend change. It's just telling you that momentum in individual stocks may be waning. So it's important to look at this at market peaks and market bottoms. So that's when it's useful. So, it's not necessarily a great useful indicator, if you're not using it and incorporated it properly. So there's the price phase. And that's why right there, where we started de-risking right here. The market, the 10-day, we haven't even broken the 10-day and we're de-risking some. And you can see that's followed by now over the last subsequent days, the moving average convergence divergence indicator turned to a sell signal. You can see that like 4 days ago. And you can see we're in this uptrend. The momentum is quite robust. Everything's normal. You had a brief pullback here on that May period, that pullback moved to new highs. And now the momentum here is you're on a sell signal. So we don't know if this sell signal, Richard, will just be, something, that's very short term and we recapture and recover this, or if this will turn into something more ominous. But this is how we were utilizing this is while we're utilizing things like the MACD and price phase and so forth to see, okay, to let us know, to alert us that, we don't have a trend change, but we have a momentum change that might be significant. So that's why we're watching this closely, right now. That's why we de-risk. And that's why we've got so much cash in our trading accounts, because of these momentum might be waning right here.
Yeah, perfect. And how much do you guys typically de-risk? Is there a percentage amount that you like to take off, or does it kind of depend on the situation?
Wes, go ahead and answer that one.
How much would we de-risk? In our long-term portfolios, I think when we want to de-risk, we'll probably look at where we can take profits on stocks that are extended. So we did that, with NVIDIA. We did that with Eli Lilly. We sold Pure Storage. So that probably, we probably raised like 25% at that point in time. With that. So I think that's what we try to do first, right? Case by case, de-risking and thinking about that. It's mostly on an individual stock basis anyways with that. An example of a stock we had to sell Friday was PWR, for instance. That was, it was below the 50 or, close to the 50, and it broke that low from like 2 or 3 days ago. And that. So, if we're de-risking to the upside, it's certainly on an individual stock basis, but always we have these things that don't go our way, and you just have to take that with you. But the thing is, in our long-term, what we call our longer-term portfolio, we do give everything, like we say, we give it as much of an opportunity to succeed as we can, right? You want to let it go through that, and leading stocks go to the 50-day. That's fine. That's very normal. And so, we were giving Power, this Quanta Services, every opportunity to succeed by letting it go to the 50, and then finally, having to cut it just based on the action. But yeah, I'd say, yeah, that's anything to add there, Roy?
Yeah, and we actually sold this taking out the prior day's low, Richard. It was down
Mm-hmm.
2 when we sold it on Friday. So, it came down to the 50, went sideways a day, and then it came unglued. And again, you don't know, no one knows if this, if buyers are going to show up at the 50-day or not. And you just have to assess and identify if and just take a look and be situationally aware of what's going on around you. But there's the break, and you don't always get it right. Let me just show you, for example, we were this arm, ARM. Yeah, see, look at this arm, and I'll point this out. And this was a big winner of ours, Richard. We bought it way over here at 65, got a double out of it, sold half, kept the rest, and we ended up selling it here on the break. And this is when you had that April correction where it held the 50 and then it just came unglued. And so you never know where they're going, where they're going to dump it, but you just have to respect the technicals. And you can see right there that it didn't hold. And during that period of time, while we were bending with the market, we actually sold Kava, Richard, right here the second day because it broke the 50. And we said, man, this thing is about to come unglued. And it did not. And it held up. And unfortunately, that's one of the big mistakes that we made this year, is not participating on this Kava from the break of this down trend line to today.
Yep.
That's trading.
It is trading. And let me just point out this NVIDIA, so you can see this. So the NVIDIA, see, there it peaked, or excuse me, the price phase peaked that day. So we were watching this closely, and on the gap up, we started selling, Richard, right here, because we're up 50% in the stock in the course of a month, and we had a huge position in it. So we actually sold into this, and you can see the next day, that day, the price phase turned down, the day of the reversal, and we sold the rest of it in the trading accounts, and we sold, or during this period of time, we sold 50 or 75% in our core accounts. So we took this way down, and we're waiting to see if it holds here. See at the 21 day, but you can see the price phase is still, the momentum is waning there, and we're on a sell signal on the MACD. So we want to see what happens. Remember, price trumps everything. So we know that we've got support here at the 21 day. We know this is a leading stock. You had a mass reversal day, though, where you should have de-risked. And so we'll see if we can hold the 21 day, and we will trade accordingly from here. On it, we'll either add exposure or we'll sell exposure, taking out that low right there that we put in 4 or 5 days ago.
Yeah, and this is more of a clarifying question or point for people watching. Just because you guys are talking about selling into strength or selling more aggressively when momentum wanes, it's not that you don't believe in the stock anymore, the longer term trend has changed. Just at that moment, it doesn't make sense to have that exposure on. And like you said, with NVIDIA, it could continue to be a strong performer. You're just waiting for the next setup, the next opportunity to increase exposure again. Once the conditions are right, the risk, the spot to manage risk there is there. But so that's just kind of my take, but anything to add or clarify with regards to how you guys view things?
Well, barely maybe to add, but we were talking, we've been, since it was a big position, we of course we're looking at it every day, every hour, and we know, okay, it's very normal for stocks to come into the 10-day, 21-day, all that. Of course they're going to. And we were just doing the math. Okay, it opened up at 140 bucks that day, and we're not willing to give back 10, 15, 20%, just because of a normal reaction, even
Right.
so it's partly because of the position size where you can't handle the, normal.
Right.
So we're more cognizant, I guess, of those normal reactions because it might be a little bit bigger than, some people's typical position.
Yeah, for sure. Roy, anything that you wanted to add?
Not really. I think
Okay.
we've covered quite a bit. So
Yeah.
hopefully, your clients, Richard, the thousands and thousands and thousands of people that follow you and read your stuff and, that have enjoyed your great interviews over the past. We've listened to all your interviews over the last 5 years, and we got to say that they've been remarkable. And we have those all stored away. And we actually go back and listen to those occasionally with your friends, Lee Sorday, Oliver Kale, and all your constituents, Mark Ritchie, Mark Minervini, Stan Wiseman. And so we thank you for what you do to the community. You're a terrific pioneer. Your vision is amazing, and we're excited to see where you go and where you bring us over the next 20 years, Richard.
Well, thank you very much for the kind words, Roy. I wasn't expecting that, so thank you very much.
Yeah,
Thank you guys for your work, for putting this together. Like I said before, we always appreciate having you guys here at the conference, and I think today was very valuable for people and addressed a lot of important questions and key problems that traders face. So thank you guys both for the time. To everybody watching, I hope you guys enjoyed. Make sure to leave a like down below. Thank both Roy and Wes in the chat. And check out the links that they shared as well.